Welcome back, everyone. Michael Rosmer here with Offshore Citizen, and today I'm going to answer the question of what is a hybrid mismatch, which is a kind of corporate structuring tax term. So before I dive into that, click the subscribe button and the notification bell to be notified of when our future videos are coming up. And let's dive into this. Okay, so what we're talking about here is a concept that you would hear quite a bit if you dive into the world of international tax and understanding. There's something called the Base Erosion Profit Shifting Action Plan that was put out by the OECD. I think it was 14 points a few years ago, and is kind of the guidance for how internationally companies are developing their tax systems. Okay, and one of the items that they talked about is something called hybrid mismatch. There's a variety of different other areas where they talk about hybrid mismatch. And a hybrid mismatch arrangement is essentially when there is differences between how two countries treat different items for purposes of tax. And so perhaps the most famous of these comes between Ireland and the US, and how it was utilized by Apple and some other international companies for quite a few years. Okay, so I'll talk to a lot of people. I was just having a conversation with someone the other day, and they were discussing, hey, listen, Ireland for low taxes. And I've heard this kind of myth a number of times, because people will say, oh, Ireland, zero tax or low tax, they hear Apple's there. So, I once sat with someone who didn't know what they were talking about, and, they kind of heard what I did, and they're like, oh, all I know is if I was, making millions, I'd just set up in Ireland. And I was like, okay, well, you have no understanding at all about what that structure is about. So we're going to explain it a little bit. I'm going to give you some other examples, and then we're going to kind of dive into how things go here. So let's take a look at the Ireland situation. So what happened in Ireland was Apple had a company, Apple, the main Apple corporate in the US, and they ended up forming two subsidiaries. They formed a number of subsidiaries, but two in particular, Apple Sales International and Apple Operations International in Ireland. Okay? Now there's a whole bunch of reasons, aside from what I'm going to discuss, why Ireland was relevant. There's something called the same company or the same country exception that helped with the Subpart F controlled foreign companies rules in the U.S., and there was the look-through rule, and there was a whole bunch of different things going on there, and how they would route royalties, and the royalties directive within the EU, and all kinds of this stuff. But the core issue here was the subject of tax residency of a company. And you can go and watch our video on what is tax residency, or what is corporate residency, personal residency, etc. But from our standpoint, what's important here to note is that there was this, there's a company, its full income is subject to tax where it is resident, okay? Not where it, but the important thing to note here is this is not the same necessarily as registration, okay? And this is where the hybrid mismatch came in. So every country has a standard under which they determine how a country is resident. Now, sometimes this is not very explicit in statute, and so it comes out kind of through cases, etc. But the bottom line is some country will somehow decide, hey, what makes a person or a company resident here and therefore subject to our tax rules, okay? Doesn't mean they're going to tax them, but it means that they're subject to that country's rules, okay? And that's on their full income. So even if there's a territorial tax system, a country that has a territorial tax system, the full income is subject to the tax rules in that country if they're resident there, even though they don't necessarily tax the full income. Okay, so that's a little bit of a nuance. Okay, here's where we go. So from there, you have a mismatch in the corporate residency rules in Ireland and the US. This has changed now, by the way. But back in the day, from long, long back, the Irish system was based on British common law, which tended to look at the place of management and control. Okay? So, okay, great, you have the place of management and control, meaning that a company was resident where the management and control resided. Now, in most British common law countries, for example, the UK itself, for example, Canada, for example, Australia, for example, you can start running down the list, right? Those places generally used both management and control and place of registration, meaning that, for instance, if you're looking at Canada, a company is resident in Canada if it's registered in Canada, and also if it's not registered in Canada but it's managed and controlled in Canada, it's still resident in Canada. Okay, that's the way that Canadian rules work. Now, and that's very common around the world. That's probably the most common system, unless it's overridden by an applicable tax treaty, which sometimes it is. Okay, so the U.S. system didn't apply management and control rules. It only applied place of registration. which is much more rare. You'll sometimes see it in countries in Eastern Europe. It's quite common. For example, in Bulgaria, that's how they do it, okay? So what did this mean? This meant that Apple could form a company in Ireland, and they said, hey, if the Irish tax authorities, or the US tax authorities came, they would tell them, oh, that's not a US company. That company is registered in Ireland. So according to your definitions, we don't meet it. Okay, great. Other rules apply, but that one does not. On the same time, Ireland only applied management and control rules. And this is, again, very rare, okay? So pretty much the only ones, aside from special types of companies that had this, were Ireland, Gibraltar, and Cyprus, okay? So, all right, great. They said if the Irish tax authorities came, what they did was they managed that company in California. And so when the Irish tax authorities would come, they'd say, hey, this is not an Irish company. Because according to you, it's resident in Ireland if it's managed and controlled in Ireland. We have no people there managing this, so therefore we can't be met. We said, okay. What did this mean? It meant that you had a company that was for like 30 plus years tax resident nowhere, okay? And that meant that they were only, they would have, again, some other tax rules that would apply, but the majority of the tax rules would not apply. And so this was a hybrid mismatch that allowed them to get away without paying tax on tens of billions of dollars, okay? Lots and lots of money. Saved a ton of tax through this strategy. Since then, I think it was around 2019 or something like that, that they finally totally closed this up, but they started to close it up before then. And so it's no longer an option in Ireland, and Apple has relocated a bunch of their stuff to Jersey. But anyway, whole other conversation. So that's an example of a hybrid mismatch. Now, hybrid mismatches can take many forms. So for instance, one of the most common ones that we see is sometimes the LLC concept, right? So LLCs are a corporate form that's not recognized in a bunch of different countries, but, you can have them in a foreign country, so then how does it get taxed? And we see, for instance, how you get this conflict between the US and Canada, the US and Australia, the US and UK, and it's sometimes spelled out very clearly, and then most countries it's not spelled out at all, right? So then you start to say, okay, well, if you have a single member LLC, which is taxed as a flow-through entity in the US, then there are no dividends paid out, right? But if Canada, say, recognizes it as a corporation, which it does, then a distribution from the LLC is a dividend paid out. Well, what does that mean? That means that you're going to have this mismatch in terms of how it gets taxed on each side of the border. Okay, so that can be very beneficial. So hybrid mismatch arrangements are extremely helpful in tax planning if they go the right direction. Now, what the consequence, of course, is, as I said, is we now have some rules that have come out to try and address and tighten up these hybrid mismatches. So they're not always available. But that being said, where they can, where you have mismatches in residency rules, mismatches in source income rules, mismatches in trust rules, mismatches in corporate forms, things like this, you can get some good advantages. You can also see this not even in the realm of tax planning, but with respect to, for instance, how tax planning will overlap with the place that you can get payment processing set up. So you have some of these, and we're moving away from that as we move to this world of substance, which is kind of the norm today. But that being said, it's quite helpful. So anyway, I hope that kind of explains the concept to you. If it doesn't, write some questions below. I'm happy to answer them for you. If you like the video, please like it. Click the like button. Subscribe to our channel. It really helps us out a lot. Click the notification bell. Share it with your friends. And if you would like some assistance, feel free to book a call with me. There's a link below, clarity.fm/Michael Rosmer, where you can book a call. You can also go and you can reach out to us through our websites, offshorecitizen.net, offshorecapitalist.com. We can help you with, international tax planning, with asset protection, with merchant processing, with citizenships, residencies. Let's see here, what else? Company formations, bank accounts, brokerage accounts, all that stuff. Anything to do with international pretty much. So anyway, hope that helps, and we will talk to you guys on the next video.